So, my video got corrupted due to my own fault. So, I'm making this case study for you guys for basically everything we went over in the webinar today. So, hope you guys enjoy. Let's start off with gold. So, the price action we dealt with was we just taken out this high and then price induced sellers. So, let's go over that because we had Monday's price action into this area. So, we noticed we had a liquidity block. Therefore, we know that we could potentially have reactions from this area. Why? One, there's no liquidity below this low yet, and we just induced sellers. So any sells in this area should be some sort of high risk entry, lower probable. So here's what we get. So in this price action, we come up, trade into this inducement high. We have a sell off, creating a liquidity block. Then we take out the high. We come and take out the high. So we induce buyers into the market, then we trade down, trade lower, and then we induce buyers yet again. So on my chart is when I saw this, I'm looking at it from the 1 hour perspective. Therefore, when I was looking at it from the 1 hour's perspective, this high was taken. Therefore, our inducement high was taken and potential sells could have happened. So therefore, we see an easy target, this inducement high. This inducement low. I marked out that inducement low is because we took out this low. So that low to that high, we took out the high. I'm like all over the place right now. So we trade into this area. And look what we do. We induce buyers from this area. So since we induce buyers from this area, it's very key that I want to see price return back to this inducement low. I've taken this trade on CFDs. I wasn't able to capture it on futures though. So high risk trade just because of what we explained in the webinar as far as these highs are still intact, but we've taken out that high from the left that we were inducing sellers from. So now we can anticipate price inducing sellers yet again after taking out this high. So once we take out this low, that indicates that we have just trapped buyers. And there was yet another entry that we could potentially take, that being this inducement high. So this inducement high gets taken. Therefore, you have an LB above as well. LB was right there. Another potential entry, another high risk potential entry. Remember, these entries are high risk just because of the premise that we still have this high intact. This high is intact. And the reason why I was able to take these entries and why I had conviction in taking these entries, again, when I looked at it from the 1 hour perspective, I saw this as my inducement high being taken, therefore targeting liquidity to the downside. But me being aggressive with my management, just because of when you look at it from this perspective, you see that the highs are still intact. So I took this trade to these lows. This trade wasn't an entry that I was in, but I explained that I would want to take it to these lows because there's some sort of buildup here. Look at how this price action forms. We induce buyers, respect this low, move away. Notice how we build liquidity at this low. And therefore, we trap buyers. And look at what we have here as well. We have an inducement from the left. So once that inducement from the left gets taken, price reverses aggressively and runs for that buy target. As buyers get trapped, and it runs for those highs. So notice how, yes, these entries were counter bias, but look at the management. If you manage your trade correctly, you can get into these entries and cap your risk, get out of the market, and potentially still make a profit while playing the inverse direction. But I highly recommend not taking these entries in the case of whenever direction is clear, because remember, I took it under the guise of my 1 hour, the high is being taken. So I had confidence in taking it to the inducement lows. But all in all, price runs for the buy target and also runs for this target as well. So now we're met with a framework of we just induced buyers after trapping sellers. So now we're in this framework of reacting from this area to the left. Therefore, this area is an area we're going to anticipate us to induce sellers from. Why? Because since we just taken out liquidity from the left, we just induced buyers. We can anticipate us inducing sellers to engineer liquidity above these highs. So now let's break down this price action. Here's what we get. Okay, so we take the high, take the low, and then now we're reacting from this level here. We react from this level here, and notice how we induce buyers. We induce buyers, so that's what we like to see. Sorry about that. We induce buyers from a trap area, letting us know that we're building liquidity at the lows. So we build liquidity. We create a liquidity block as well. Where's that price action? So look at this. I spoke to the guys in the webinar and said, here's a tip. Since we take out this low, inducing sellers, we have taken out the lows to the left that induce buyers for one, but there's liquidity that is still intact into this market. So sorry about that. My mic is like tripping. Okay, let's get that fixed. Okay, perfect. All right, sorry about that. Technical difficulties. All right, so we create that liquidity block. We create that liquidity block here. And if we leave these lows intact, we can see a short whenever we see the inducement high getting taken. And then where's the inducement high? Here. Notice how that's the last point before we have the sell-off here. So you have a liquidity block above, inducement high, and you have the draw on liquidity there. This was an entry I was able to take on a lot of the evals I was taking, which helped me pass it, as well as some funded accounts, but with low risk. So more of a high risk play just due to positioning for me, and as well as, you know, how we take out this low. It's still a high risk play because we've induced lower, but in my opinion, I was still confident in the trade just because of the fact that we can take it to the draw on liquidity from the downside, just really respecting the lows and moving away. So there was also another potential continuation that we could have taken. So look at how we respect this low. We respect this low. We take the high. So we take the high after respecting the low. Now, you could have taken an entry as soon as the high was taken for one. Either like this to the lows, or you could have taken another confirmation entry here. So notice this. We have this area here. Price stalls it here, takes out the low, respecting this low from the left. Then we trade up, taking out that inducement high. So there's a confirmation continuation entry in there as well. And then there's yet another entry as well. So I didn't go over this entry in the webinar. noticed it just now. I can't believe I missed that. So you can take it off like that. And then now that entry that we just taken has formed a new LB. So let's actually draw our LBs out, because gold provided many opportunities to sell this price action. So we create that LB with this entry here, and look at what we do. We take out this low, but we leave the lows to the left still intact. And what takes out that low? This inducement high here. We can agree, high, low. We've taken out the lows, but we've left the lows to the left intact. So as soon as that high gets taken, you could have taken yet another sell. Look at that. Why? That LB that took out that inducement high is now your new LB. And we're still building all this liquidity to the downside. So the potentiality of taking 4 positions with that one trade idea just to the lows on gold is insane. Look at the potentiality that you could have caught. I was only able to involve myself in this one because whenever I'm in one trade, I kind of not really look to scale in. But if I was, these would have been very, very nice positions to take. So that draw on liquidity is taken. And then we move on to price action that was in the next coming days. So here's the price action we get. We've just induced sellers by taking out these lows. Let's mark out these lows. So these lows were taken. Notice how we had that move up. Price runs into this low with the gap, trades into it, reacts from this area here with this price action, and just sells off. We induce sellers. So knowing that, I want to play the market from now bullish lens because we just induce sellers. So here's what we have. We're reacting off of this area here. Let's actually go to 15. It looks clear for you guys. So this is our inducement high, but it's also a liquidity block, so we can see reactions. We react from that area, and then we induce buyers. We induce sellers, sorry. So we induce sellers, and then now we take out this internal point. Now that we take out this internal point, we can see price run for the next internal point, the lows. So where could we see price run to next? Because remember, we're still respecting the inducement high. Price ran here. That would have been a potential entry that you could have taken in London, targeting these highs. I didn't take it personally just because I didn't want to be involved in a trade that I couldn't manage personally. So that would have been a nice scalp to those highs. I personally would cap my risk here just because, you don't know if price will reverse above here as well, because these are areas that we are anticipating price to induce sellers from. So we trade to the next point of liquidity and we induce sellers. How can we involve ourselves in the market? Every time we react from these areas and induce sellers, remember, we're generating liquidity to the downside. So that's what we want to keep in mind of. So we react from that area. And then here's what we do. So how I would have involved myself in the market, even though I didn't get into this trade, is we took the high. I would not have taken it as soon as this low is taken, just because that's not enough context for me. I like to take more high quality trades whenever the inducement high is respected. So therefore, we take the high and then we take the low. So therefore, once you take the low, we induce sellers. So now that we do that, we created a liquidity block for ourselves to have a stop loss. So now here's what we do. You don't even have to go to the 1 minute. Look at this price action from an intricate lens of paying attention to the candle formations, right? So we have this high that gets respected. We trade into that high going up. And then now notice how we take the last low before the liquidity block, the low. So now here's where I would take an entry here. Oh, wrong tool. I would take an entry here. Now, in a real life market environment, I'm going to cover my stop below here just because there's no telling that price wouldn't come below here just to still respect this and then move away. I would hate for that to happen to me, so realistic events, I'm covering my stop right there. So therefore I will be targeting this high as well, the high that we've engineered liquidity at. So just showing you how you can play the market from liquidity to liquidity point. It's just waiting for these reactions to form, these false reactions to where we induce traders, and then we trade into the liquidity. So now, still going forward with price action, we induce sellers. So now that we induce sellers, we want to see price react from an area. We react from this high, we induce lower, taking out that low. And what happened in that general area? Let's see what happened. So we take out that low, and almost like the same scenario, it's not enough context for me, in my opinion, just because we've taken out this high and then we've taken out the low. I'm not saying it's not a valid entry. In my opinion, it's a high risk play. I don't have enough data on these type of entries where, it's so intricate like this, and we just take the high, take the low. Now, I get that we do respect this, is why we take the low in inducing sellers, but I would have wanted something more clear cut that I can be confident in putting my risk on. So therefore, I wouldn't put a risk tool just to say I would catch this. This is a trade that's in a gray area that I need to test more, but it aligns with the direction of we induce sellers and we have liquidity at these highs. So therefore, price moves to the upside. And then what do we get the next day? So let's clean this up because this was actually some good price action to go over. So remember, we induce sellers. Okay, now we have a liquidity block area, guys. This area is a liquidity block, but we don't want to be trading from there. We want to see if we can get potential false reactions from these areas to build liquidity in the market for us for the future target. So we'll draw that out. Boom. We draw that out. Okay, so now whenever Marco says we respect an area and move away, I kind of like to articulate it in a way that you guys could, visualize it. We respect it, move away, but move away in inducing traders. So inducing traders by taking out a low. So what do? We want to see that happen. We see price coming to these lows. Why these lows? So remember, we've induced buyers from those lows by taking out this high, and then notice how we've traded back into this area. Notice how we've traded back into these lows. Respected it, moved away, and now look at how we have false reactions coming off of the back of that low. So let's just drag that out. This whole area is an area we don't want to be trading from. We induce buyers off of that area, letting you know early buyers are buying this thing. So now we get an indication of early buyers buying that price action. We know that we're getting some sort of false reaction in the market. So now we take the low out. Now that we take the low out, we trap buyers. And we also do what? Induce sellers. So now sellers are induced, buyers are trapped. We now have liquidity above these highs. So now we want to play price in the framework of we want to target these highs. So price action develops. No real clear depiction of trying to catch an entry in this level of price action, honestly. What price does is runs for the internal point and then it moves away. So price runs for the internal point, respecting retail again, and then it just moves away. So I would have liked to seen price come below these lows at a more adequate time, but 4:30, I'm not taking this limit order or this trade just because the timing is just terrible. Anything can happen over the weekend, so therefore I wouldn't put that risk on myself. But in any case, that was the framework we had on gold. Now let's move to NQ. because NQ was pretty clean. Let's actually explain this, guys. So let's redo this. We know that we are in a bullish market environment. Why? Because we've taken out these lows that we were talking about. Bam. So we've taken out these lows and look at the highs we have intact. Price could even potentially run to these highs, but let's not speculate. We came to do a case study. So here's what we do. This price action shows that we induce buyers by taking out these highs, but we still are bullish because we have all those highs intact. So let's actually refine this to a more easier way to spot this. So I want to see price above these highs. Yes. So since we take these highs, we need to see sellers get induced and buyers get trapped. So price reacts off of something in this area here above that inducement high that was taken. So let's just refine that. So let's go to the lower time frames and let's actually bring ourselves into this price action. Let's just, okay. So here's what we do. We induce sellers by taking out this low. We can all agree that we just induce sellers. Look at that build up of price action. And that low takes out this high, which gives us an inducement low that was taken. So notice how what we do here. We respect this high, and then we come to the low, the internal low. We take out the internal low after respecting the high. So we just respected the area and induced sellers. What does that give us? That gives us a liquidity block. And also, that gives us a framework of we have liquidity above this high. Okay, cool. So now, what do we want to see? We want to see buyers get induced into the market. And we see that happen in the form of this high getting taken. So now, we have an inducement low in the market. We want to see this low get taken. And let's refine that for you guys so it looks cleaner on the 5 minute. Okay. So, we take out this inducement high, inducing early buyers into the market. We want to see a build up here. We want to see an indication of early buyers getting into this market to let us know that we have liquidity below here. So, okay, I'm getting into the flow state now. Let's go. So we take out the high after respecting this area, guys, right? So now we want to see buyers get trapped. Buyers get trapped. And now I'm not taking an entry at 4:20 a.m. just because we're all sleeping and I don't trade NASDAQ in London or Asia session. So wait for New York. So here's what we do. Price trades up and then induces higher yet again. Price induces higher yet again. But look at this. We're still below this liquidity. So since we're still below this liquidity, I still have a bullish framework. I still don't want to sell this. Price is now reacting from these areas that is essentially building liquidity towards the highs. So price reacts from that area. And look what we do. We have a false sell-off. We have a false sell-off. And what does that do? That generates liquidity above these highs. Me personally, I forecasted to take a long below these lows, but before this happened, I looked at YM and YM looked way cleaner than this price action. And I wanted to put risk on YM instead of this just because of the formation of the price action I liked better. But this is still essentially a valid entry to take. But here's how I would play in a real life market environment. I would cover my stops below here. Just like the same gold scenario that was talked about a few minutes ago of, price could easily take this level out, respect the one before, and move away. I would hate for that to happen to me. So just be conservative with the stop, even if it's like 5-10 points. Who cares? You're still getting a great RR on the trade. So nevertheless, your targets here. Here's a safe target. Your engineer liquidity target. Easy. Basically a 9R trade. Amazing on futures. If this was taken on CFDs, I mentioned I would take my trade. I would partial here. I dollar partial there, and my final target would be those highs that we're targeting on a higher time frame. So that's NQ, and I'm gonna show you why YM's price action looks better. As you can see, like, and if we look at it with a no drawing lens, a lot of people would have said they wanted to see price below here, and you're not wrong. But now you're looking at it from a pattern standpoint, just because we have these, we've just traded into the low once, twice, 3 times, 4 times. So it looks like we're building liquidity here. But if you don't add the logic of what, you know, price action actually did, like this, then you'll just see price as, oh, we're building up at this low, we should take the low. That's probably why a lot of people was looking to take a sell. And I don't blame you, because sometimes we can, you know, misanalyze things, but you have to apply the logic and the criteria that we look for. So let's go to YM. Let's show you why YM was cleaner. Show you why YM was cleaner. Okay, same framework. We want to see price above this high, bullish market environment. So what we did though is we took out this high to the left, right? We took out that high to the left, and we induced sellers. So let's go to that price action. I mentioned in the webinar here that this is what we did. Look at this price action here. We traded above the high, we respected it, and then we traded above the high again. So let's mark that out for you guys so you can see. All right. So all that price action basically is, guys, is this. Let's like put that to a visualization or a diagram for you guys. So boom, respect it, respect. Oh my God, that looks terrible. That looks terrible. Okay, let's redo that. So boom, respect that area, boom. So all we did now is we just trapped those buyers. So that's what that price action is. Okay, so now let's get into this. We induce sellers. We induce sellers. Okay. Sorry about that. I got distracted for a second. Okay, so notice how this is what takes out that high. Now we have a buildup that gets taken. We induce sellers. Guys, we do not want to be selling anywhere in this price action here. This gives us a framework that we do not want to be selling. I do not know how to use the brush tool as good as some of you guys, because it's just hard. But yeah, we do not want to be selling anywhere in these areas, guys. This is retail basically selling this price action. We do not want to be getting into this. So what we see here is we respect this area, this internal point, which is a inducement high, whatever you want to call it. Yes, this is a liquidity block, but it's not a liquidity block we want to be trading from. Remember, I just broke down that we're in a bullish market environment. We just wanted to see price induce sellers. So look at what we do. We react from this level, and then price takes out these lows, trades up into the high, respects it, and then come towards New York time, price takes out the low again. So what does that do? That forms a liquidity block for us. And now look at this beautiful price action that we get, by the way. So let's actually break this down, because I'm gonna show you what like gave me conviction to say, you know, toss NQ to the side. Let me trade YM right now. So here's what we do. We took out this high. Why did we take out this high? I mean, what took out this high? I'm sorry. This candle here took out that high. So, you know, I hope you guys know like how candles actually form. So bearish candles, they tend to go up before they go down. So this move induces traders by inducing buys first, then takes out the low. So sellers got induced. then price took out the high with this candle here. And we did that all while respecting this high. So the fact that we respected the high to the left here, all that liquidity, we respected it. This gives us a framework that as soon as we see buyers get trapped, sellers get induced, and this high stays intact, buy the shit out of this market, because we have a liquidity block below as well. And we have engineered liquidity to the highs, like in the form of this price action here. So as soon as this low goes, buy. And look at the timing, 9:30. So as soon as that as soon as that low was hit, buy. Target that area that we were targeting. And here is 2 other potential opportunities that you could have gotten into if you missed just the 9:30 spike. Look at this. Look at what we do here, guys. We're still staying below all that liquidity. We respect these highs. Areas that we don't want to be selling from. We want to see the reaction, guys. Every time we get this reaction and every time we induce sellers, there is a potentiality that we can have some sort of buy into this liquidity. So what do? We take out this internal point. Boom. And that internal point was the inducement low. Why was it the inducement low? If you pay close attention to this candle formation. This low was the last low before we took out those highs to the left. And look at how we had a build up there. Is it a coincidence? At this point, it's not. As soon as the low is taken, buy. Now, I wasn't able to catch both of these entries, but I was able to catch the continuation. So, lucky me. I mean, I could have missed this. But at the end of the day, we want to target this as a safe target. The inducement high, that engineered liquidity that we have above there. So, let's go into the continuation entry actually. So, where's that? Jesus. Okay, so here's how I play price. Sorry. So once we take out this low, this inducement low, we respect that liquidity block to the left. But as we do that, we also form a new one. We just formed a new LB. So now we're trading into this inducement high here. So we respect it. I like to see that. You guys know that I talk about it in every single webinar. Now we induce higher by taking out this high. Very intricate stuff. And as soon as we take out the low, guys, I pressed buy. Now, reality, my fill was like above here just because I was doing something at the same time as I was trading, which is not recommended because you will miss these entries. Target here. Now, I walked away with 5R. Honestly, I was under the guise of I don't want price to reverse after taking out this inducement high. So therefore, I was okay with targeting this. But that's not saying that you couldn't have targeted this high. You would have dealt with a small little pullback maybe, and if you're watching the 1 minute or whatever, but in any case, could have maximized your profits. 7R. You see, like, in these standpoints, when I look at risk management in the lens of, do I really need to choke the trade and hold it for 2 more R when I just got 5R? You know, like, what if it goes to break even? I lose 5R just to gain 2. You know, like, I look at it from the lens of that perspective, because there are times where, you know, we could take this, respect that area, sell off. So who knows? So I like to take my money in the futures market. And that's really what we went over in the webinar. Like, guys, I'm sorry. Like, I've been very incompetent when it comes to, like, these fucking recordings and my hardware. Like, this one was definitely on me. Like, I should have made sure, like, I pressed done, but it is what it is. I hope I'm still providing, you know, adequate and quality value for you guys. And that's what I will continue to do. For the guys that did show up for the webinar, I appreciate you for, you know, taking your time out to watch. for the guys that are still gonna watch the case study, apologies that I didn't give you the most in-depth, value that I was giving in the webinar, but I hope I came as close to the quality. So I will see you guys soon. Hope you guys enjoyed, and let's have a killer week next week.